Joining us now here, Post 9, Citigroup U.S. equity strategist Scott Chronert. S&P target of 4,000, just a little bit below where we are right now. So T-bills and CDS, they're starting to price it in. Not so much broader equity markets. Why not?
I think the 2011 compares where most people go with this, and you look at it, and the timeline is that it wasn't actually the debt ceiling issue that caused the concern. It was actually a downgrade, right? And that led to your...
And that came when?
That came a couple of months later, so it was sort of but that was your 15% drawdown. And so when you look at this, it's like, okay, is there enough evidence here that says I need to sell versus, well, if you do that, then you have to be prepared to buy in the pullback because you then had a very strong multi-year rally after the event in 2011. So essentially where we're going with this is that this is probably one of those situations where you want to consider insurance. And that can be via an index hedge, if you will, or what we're doing is actually talking about basket of securities that actually has a high level of revenue exposure to the federal government, sort of a way to back into this.
So you do expect things to heat up and get worse from here?
I think the rhetoric is certainly going to continue. To say with confidence how it's going to play out, as you're discussing, is pretty hard to dial in. So at this point, we think that we have to assume a base case where this is going to be resolved, but how it plays out, there's probably some volatility along the way, and then we're trying to position for that.
Do I want to sell the market then here?
I don't think you want to sell the market, but like I said, this is one of those times where I think it's worth paying for insurance or protection. And so we're saying, look at this. It is a good opportunity in our view, given where implied vols are, to consider some hedges. And like I said, you can talk about broader S&P. We've talked about the aerospace and defense component of the industrials as a place where you look at its implied vols are actually low versus history. So not much is actually being priced in relative to what you're seeing in terms of U.S. CDS, if you will. So we think there are some ways to express a more concerning view on this without go all out and saying sell the market.
Bob Bassani is very frustrated about the fact that the market can't break out of a range, that it's sideways. Bulls are frustrated, bears are frustrated. What breaks us out in which way?
I'm frustrated. So, we're using a fair value model for the S&P that says the S&P ought to trade 14 to 18 times. We're 18.5, if not 19 times now. We think earnings estimates probably have a little bit more downside in the second half of the year, not material. So what we need is either more confidence that we're going to navigate through to a soft landing scenario, or we need more cushion on the 10-year yield front, which we don't think is forthcoming in the short term.
But Citi still expects 50 basis points of hikes.
Yes.
And a soft landing?
And you have a 4,000 price target on the S&P,
That's right. Yeah. So the 4,000 target, I get there a couple of ways. 18, 19 times our earnings estimate, 213 this year, which I think is a fair assumption. We also do a certain scenario, and this is where it gets interesting. Mild recession still base case. That gets us roughly 4,000. Soft landing, we can talk about a 4,500 number. In a more severe recession, you dial it down a little bit. We think we're, now looking at obviously still mild recession as our base case, but pushed out. There's a little bit more rhetoric. The further you push it out, the more you lean down a soft landing path. In any event, where we end up is that we think, based on our fair value work, that a 4,200, 3,800 trading range makes sense. We want to be in the equity market at this point. The closer you get to a peak in the Fed, there's no question. There's a lot of money out there that's going to want to be following the Fed, as it has over recent years. So you want to be in the market. It's just a question of when you want to be more aggressively adding to positions, and we're looking for some pullbacks as a better entry point, if you will.